Welcome to Hedge Interview. This episode is part of the Investor Views series, which features family offices and other institutional investors from around the world. My guest today is Cathy Dong. She oversees investing across all asset classes in the US and Asia markets. Prior to her current role, Cathy has held director positions at 3 other family offices where she was similarly responsible for making allocations across various asset classes. Thank you for joining me today, Cathy.
Yeah, thank you, Jennifer, for having me here.
Great. So I'd love it if you could tell us about your experience. It's very interesting that you have such extensive experience allocating across multiple asset classes. So as noted, tell us a little bit about your experience in these global markets and across asset classes.
Yeah, for sure. So for me, I was born and grew up in China. So I educated in the UK when I was around 17. So after there, I went to the US for work. So my first job was in New York. It's a single family office. I was on the hedge fund side. So we do have a fund of hedge fund, and we also have our trading team. It's a small house, but I just pick up law. And then I went to West Coast. For a second single family office, and I was on the VC deep tech investment role. So basically investing in deep tech startups, usually seed round, pre-seed round in Silicon Valley, and hoping to bring them to Asia. So it's something like the bridge between the East and the West. And then 1 month before the COVID, I joined a Middle Eastern family office. And because most of their investments are in the US and Europe, and plus the COVID years, so I was stuck in different countries and I have some different experience, but majority of our investments are still in the US. But in that house, I was more on the M&A and buyout role, so more on the traditional business side. So since April this year, I joined my current firm, which is my 4th single family office. I'm backed by American property developer. So yeah, so currently we hold most of our operational business in Asia, so mostly in Thailand and in Malaysia, and in the US we still have some. And we're quite diversified. So besides property, we also have some agricultural farming, we have some commodity, etc. And we are looking at some F&B business as well. So in terms of our asset allocation, so now I would say it's like a more comprehensive role. So I look at both the public market and private market, both in funds and direct deals, depending on the different strategies. Yeah.
Wow, that's extensive. How do you determine your focus across all of those different types of asset classes? How do you zero in and identify opportunities in such a vast areas in all those areas?
Yeah, so firstly, I think you need the goal. So what are you achieving? So you are doing more wealth preservation or wealth growth. So for us, I think on our traditional business side, we're just very traditional. They are all heavy assets, brick and mortar. But on the investment side, we adopted a very aggressive approach. So we have a higher risk profile actually. So for us, right, so we have 6 people around. So each of us have a KPI for about 10 to 12% cash return every year. So we have to achieve that target. So it doesn't matter where the return come from. It can be a IPO, so you get the return, or it can be a interest payment, or it can be a dividend, whatever, but as long as you can achieve that return. So if you hit that return, you're allowed to allocate to the other assets, predominantly illiquid assets like PE, VC, buyout. So for us, I think, so basically we have a stable return first. Then we have a lower double-digit return as our basis. Then we can be more aggressive. So that's our portfolio construction. So in terms of the specific asset allocation assets, so we're investing around 70% roughly into liquid assets and mostly funds. So that's including mutual fund, fixed income, hedge fund, and private credit fund. So the reason we regard private credit as a liquid asset is that because we require less than 2-year lockup and also quarterly distribution, or we can do quarterly redemption. So it's very liquid. And the other 30% we allocate to the illiquid assets. That's just venture capital, private equity, and buyout assets, both on funds and direct deals. But for VC, we are more into funds, and recently that's AI topic. And for PE or growth or buyout, we are more into traditional business, or you call it cash cow. So high growth, high margin, and mass market. Yeah, so that's our current portfolio. And geographical wise, we're still investing a little bit heavy in the US, around 60%, and 30% in Asia. So India is our largest market inside Asia, followed by Japan, and then 10% in Europe, just because we do not have people in the Europe. So it's more by chance in the Europe.
Okay. And so you mentioned something that I want to point out too for our viewers, something that I've heard before is that family offices are typically in a capital preservation mode or a capital, growth mode. So I guess based on what you've said, that you're in a growth mode.
Yeah.
So your allocations reflect that. Yeah. And so how do you determine? So how do you find? How do you zero in on the investments that you're probably going to allocate to? How does that process typically happen?
So you're asking how we do portfolio construction, or how we catch up the opportunities?
I guess basically like how you evaluate opportunities, or how you first, what attracts you to something? What would catch your attention?
Oh yeah, so it depends on which asset class, right? So if you're talking about hedge fund, that's also I spend most of my time this year. I evaluate around I think 40 or 50 hedge funds globally. So I think there are some takeaways, right? So for one, so for the hedge fund, the lockup period, they are no more than 2 years. So I mean, usually they have 1 year soft lockup, but sometimes they have 2 year or 3 years. So if they have the 3-year lockup, we will negotiation with them and see if they can do some a 2-year lockup or something like that, because liquidity is really important for us, and you never know what the market will react after the 2 years, right? Especially now, nobody predicts what is happening next. Yeah, so that's for one. And for two, I think it depends on the return, if they are consistently generate a stable return. So if you are only generate 7%, 8%, but you are consistently generating that ratio, that's fine. But if you are generating about like this year, let's say 25%, and next maybe the year before you just do maybe minus, so maybe that's a little bit more volatility. So then we will decide if their strategy is really attractive. So if they are trading some emerging market, we see it as a emerging market risk that you have the more volatility. But if you're trading on the US market or some other developed market, it should be, I mean, controlling your volatility below 5%, or at least a single digit for your volatility. So yeah, so that's for consistency. And for three, I think we are looking at more interesting fund managers. So I believe we all access to those big names or multi-strat or those platforms that the multi-billion size, either through banks or through just our investment approach. So I think they are a good way to maintain, because they just deliver what the market is doing and what the recent fluctuation in that way is more on the macro side. But for our, say, next year outlook, for our allocation, we prefer more interesting fund managers or managers with more characters. So in that sense, you are more differentiated from the others. So for example, this year, you see the multi-strat crowding and the increased multi-strat participation in global macro, fixed income, RV, and credit strategies. So you see, these platform beta concerns were somewhat on the back burner in 2022. So when those multi-strat funds were significantly outperforming. But with now, you see the median performance just below risk-free rates. So they are again top of mind. So I think there's a very strong expectation from us that further years, so in 2024, it will bring further consolidation or closures among those multi-strat funds. So I think, the advantage for those multi-strat funds is that they offer an uncorrelated return stream. But given those concerns we mentioned, some of us, like some of my friends or just like ourselves, we're just doing more, single strategy funds. That's more obvious. And that focus on some capacity constrained asset class or some market with a high level of asymmetry. The example could be carbon, right? Carbon credit or carbon allowance or something with the climate or just this kind of these topics. Or sometimes we look some funds. Hedge funds are usually open-ended, but we do see some closed-ended funds that do arbitrage, and also some insurance-linked strategies. So if the multi-strat fund still deliver uncorrelated returns and also downside protection, I think that would be a very interesting way to see as a alpha generation. So that's our takeaway from those strategies. Besides, we also look at the geography. So previously, we probably prefer, very centralized in the US market, especially equity long and short. And as you know, last year, just most of the managers are not ideal. And this year, they're slightly better. But you see CTA and also macro, and in the past few years, they just beat to the top. So yeah, it's always volatile. So we want to see what the other markets react to this situation, and if these equity long short or other strategies works on the other markets. So this year, I spent some time on the Indian market and also Japanese market, and give me a lot of surprise. So for Indian market, you still see long and short. It's more long only. So previously we still look at long only actually. So for those long only funds, we still consider it as the alpha generation. So they have the more concentrated portfolios, or some big names in India have a long track record actually. So that's also very appealing. So yeah, and for Japanese market, that's another picture. So if you see the performance this year, the US is still the best, I feel, and then followed by Japan. Although the yen just depreciate quite a lot, but the market is actually very performing. So yeah, so we look at some equity long and short, and also market neutral funds in the Japan market, and it's actually less crowded, and they also have some. So besides those big names in the Japanese market, and we feel so surprised that there are some managers trading on the small and mid cap, so they get good return. So I think to your point, how we allocate or how we evaluate the opportunities, there are several layers. Yeah, but for us, it depends on the strategies and also their market and their position.
How do you identify the specific managers that you're going to keep a close eye on? Do you use performance databases, or do you collaborate with do you get ideas from other family offices, or how do you do that initial screening?
In the initial screening, so we will firstly take a look at all these strategies in this year, right? So just those general types. But we say we have a higher risk profile, so probably we do not look at the RV or some single digit. So the first screen is that the manager should deliver double-digit return. That's the first screen. The second thing, then we will look at their if they are performing well, if they have the good track record along with their strategy, then we will look at some macro. So maybe for the fund managers, some of them they adopted some fundamental strategy, but for us, we adopt a top-down analysis. So we look at the combined with their sub strategies and also the macro environment, and see if they are still performing in the next few years. So we do have a 3 to 5 year plan, not necessarily only look at their past performance, because the market is always dynamic. There are not a lot of dynamics. You have to combine with the future. So we have some estimation for the next 3 to 5 years. And also for three, I think we look at some benchmark, the some database and to see if they are in that range, or if they performing, or if they're just underperforming, and if it's right time to still invest in. So so that is for data, and then I think it's really and then it's more on the personal level, on the fund manager level. We talk to the fund managers and see if their position, if they can explain clearly what they are investing or why they investing. So I think why is more important than what. Because if you generate 9%, for example, and then maybe you just drop down to 20% maybe, and then you should explain why that happens and what happens in that way. So that's about if they can circle back what their strategy as a whole. And then the most important thing now is that how they performing in the bear market. So we use some timing, right? Like last year. And if you are just flat, you are actually already good. And if you are positive, like 20%, you are top performance. So how you behave like that is by accidents, or you do have your methodology and how you achieve that. And so we compared to the success in the bond market, we're actually more care about what's your rationale in the bearish market. So there are a lot of factors.
Right. And so when you are do hedge fund managers typically present to you to give you, they give you a presentation that covers all of these points, and you obviously expect them to answer these types of questions?
Oh, yeah, I think so. So we wouldn't ask more on the tactic side, because that's more on the tech DD or something like that. And I believe they are already very good at it. And we care more about their rationale or their logic about their pickup. So for example, recently we look at the fund manager, they just follow supply chain. So they're trading on the Japan, Korean, and also Taiwan market. So that's typically renewable energy and semiconductor. That's something we are really focused on. So they just give an analysis like what the semiconductor in different market performing, and how the future, and what's the sign of the recovery, for example, in the smartphone and PC space, and also if they are still recording a slide or a modest quarter-on-quarter growth, or what would they perform. So I think we just combine into the industries. So but not everyone on that side, right? Because some of them are just very technical. So then you just look at the numbers. But for us, we are more interested in those industry-based or those sector-focused funds at the moment.
And to what extent do you use performance databases? My understanding is that there are databases where managers enter their performance and their profile, their strategy type, so that often investors and family offices will identify some managers by going into those. Do you use those particular databases to find funds in a specific strategy area?
Oh, currently, I feel it's still very scattered. We use Bloomberg more, and I think most of us use Bloomberg. I mean, it's very easy and open to use. But I guess if there are more, if other software that just consolidate all the information, that could be better. But maybe I didn't find it. But perhaps there are.
But Bloomberg primarily.
Yeah.
And I noticed that you attend a lot of events, and are events useful for you family office events specifically? Is that useful for understanding your peers and what they are looking into? Does that help with your idea and research generation?
Yes, I think so. But So if you say understanding the family office or asset allocator, their appetite, it shouldn't be the large conference because it's hardly ever just talk to people and just couldn't hear. So I think it's more on the round table. Yeah, I think I personally prefer round table discussion, and everybody they are just bring something to the table, and there are always some theme or thematic talking or discussion. So I think that really helps.
And what is it, for managers who are trying to understand family offices and who might be open to taking a look at them? I understand that some family offices may be open to emerging managers, some are not. And what would you say is a good way to reach out? What would you be open to in terms of communication? Do people ever reach out? People meaning asset managers, do they ever reach out to you on LinkedIn, or do they email you, or do you prefer referrals from other managers? For those that are not on your radar and your typical research, how would somebody get on your radar?
Yeah, so I think there are two ways. So for on our own side, because we also do some research on mapping. So we actually we reach out to some managers on our side. We do that, and also on the but more or less, I mean, they are just referred by somebody else, like Capital Intro. That's a good way, and also some peers. Yeah, either our friends or somebody else. I mean, just like a referral. Some of them also approaching us on LinkedIn. I think LinkedIn is a good way, but you have to specify what makes you different. So I think many fund managers, they just reach into us and they just give a lot of data and whatever, but it doesn't, I mean, it's not really important when you reach to us, right? I mean, you just specify some core data, and that should be okay. And I mean, you need to explain more, like why you are here, or why you think you are different. So I think your position is very important. So I think I mean, so generally for the fund managers, I mean, for us, we are very open to talk to anyone, the managers, but not everyone like that. So I think the first thing, it's better, maybe you just ask the family office first. I mean, you just do some mutual introduction, you just feel more warm, like you just ask them what's your risk profile and how you consider a hedge fund allocation, or what's your return expectation, and also essential, and also geography preference or whatever. Yeah, I think you'd better ask them first. Yeah, so some of them, they do have their clear idea, but some of them, they do not. So if they do not have a clear idea, maybe you can tell them, like you can make some suggestions, and also you can talk to them and what your strategy is and why it's appealing, something like that. So yeah, I think it's more like the interaction. Yeah, not on the just to avoid hard sell, I guess.
Yes. And so as far as point of differentiation, this is something that I stress to asset managers and say, you've got to be differentiated. You can't be just a Me Too strategy. So something, and they sort of sometimes look at me puzzled, like, I'm not sure I know what my point of differentiation is. So you have to, it's really important to identify that. And some clearly do, obviously, and that really helps. So what would you say are what are common mistakes that you would say what not to do, as far as what would turn you off in terms of your communication with an asset manager? What are mistakes that you have seen?
Yeah, I think for one, it's about their approach. So some of the managers, I understand, I mean for hedge funds, because they are very quantitative. So some of them are just very rational, or very, when they approach you, it kind of feel like arrogant in that way. I know they are not. Yeah, but the way they approach is kind of something like that. So I think just to avoid this, just try to be nice, more patient, because not everyone as professional as you, right? I mean, so that's the reason why we invest in you. So I think just to try to be more patient and nice. And then I think it's about just to simplify your strategy. So some managers, they use very complex, the terminology or some calculation or methodology, and a lot of the very complex things to explain, but people do not really understand. They do not feel you are sophisticated because they didn't get you. Yeah, so I think you just better simplify your strategies in like the 3 or 5 sentences and just to summary what your strategy is. Yeah, so I think that should be better. And also, I think better not to do is I think it's I still think not to do hard sell. It means just not to just sell your fund to everybody without asking them first. Then you do not know who's your right audience. Then you probably miss some opportunity. Because people think, oh, you do not really know what I need, but you present something I'm not interested, so they may turn it off.
Yes, that's really important. I often advise to make sure you understand, that that you're providing a solution to somebody. You don't just, you solve, don't sell. So make sure that you're a useful piece in the family office's portfolio, that they need you, and then focus on differentiation and be clear, articulate clearly. I say that over and over again. Don't be overly complex, and to speak in a language that simplifies what you do, because not everybody necessarily is an expert in a given space or area, and jargon can really turn people off.
Yeah, that's true.
Yeah. So what are you paying attention to going into next year? And that could be like on a macro level, geopolitical. What are some trends that interest you going into the new year?
Yeah, I think so for next year. So our key markets are still the US, India, and Japan. So China depends. So we think the Chinese economy probably is already at the bottom. So maybe it's the time to relook at and see if there's opportunity. So I think we're still evaluating at that point. Yeah, but definitely US and India and Japan market, but there are 3 totally different market. So for the US market, I think everything is very transparent and you just have the track record. So I think we are looking for some smaller or niche fund managers, and they can come from the big house and they're doing their first time fund. Yeah, we are very open to that. And so probably I'm just combined with some themes like AI or some machine learning or some some topics like this or defense even. So just some angles that's not just Amazon, not just Google. Yeah, more specified industries. And in Indian, I think we look at some long only as well. So mostly focusing on the some B2B sector in that way. Oh, and in Japan, I think in Japan we are looking at some small to mid cap, and see how it goes. And so that's on the geography thinking, and in terms of the industry, so I think renewable energy and AI defense, AI cybersecurity, and also semiconductor are something we really care about. Yeah, so I mean, whatever is public market and private market, actually they can combine. Yeah, so I think we are looking at some, I would say, sector focused fund managers in that way.
Do you have any focus on, you did manage renewable energy, you did mention renewable energy. Do you focus at all on SEG or impact at all? Is that part of your allocation, or just not so broadly, but more specifically renewable energy?
Yeah, I mean, it's still, I wouldn't say we are looking at the impact on the public side, because I think the making money is something we really care on the public market side. So I guess probably they are providing some solution. So it can be something like clean tech that just helping you transform the solar into electricity or whatever, and also they do some carbon allowance, carbon credit in that way. So I mean, just something related to energy. Yeah, not really specified, but in the private market, yeah, we do look at the clean tech mostly.
And why the focus on Japan and India specifically? What about those markets is appealing?
Yeah, so see, as for our current strategy, the US is still the largest allocation. And then, yeah, because Europe, we do not have people there, so I have to comment on that. So for Asia, right? So if you look at the Asian market, I mean, China, and most people treat on the Chinese market. And now, as you know, because of the geopolitics and also the inner economy and something like that in China, and I guess we're just wait and see what is going on. Yeah, so besides Chinese market, and you have the Indian market, that's the similar size of the Chinese market, but of course their public market is less advanced than China or the other parts. So we just take a look, because the Indian public market actually deliver higher multiples than the US market in terms of the B2B especially, and also some fintech financial service. And if you look at those companies, they have very high margin. So yeah, so from the private market, we look at the Indian market. Then we just come to the public market, because we have to consider how they exit. So when we look at the public market, we feel so surprised. They actually perform better than the listing in the US market. And besides the Indian market, besides China, you have mostly developed Asian market and also Southeast Asia. But Southeast Asia is very small and is less advanced. And yeah, so I think we still have a long time to see if there's any trading opportunity. Yeah, but for the developed Asian market, Japan, that's because we look at Japan honestly since this year. Yeah, because previously, Japan people are just considering it as a very developed market. There's no alpha. Yeah, but since this year, I think a lot of these sectors they are competing over. So Japan has a good. They have a good soil for the semiconductor and also deep tech. Yeah, so I think that's still a considered good market. And for Korean, so if we look at Korean, that should be more automotive, electronics, or smartphone. That's something for their flagship the thing, and also the companies, the multinational companies, they're all majoring in that, and they also do global business. So we think is the highly possibility they just further grow. So probably we look at the Korean market next year. And so Australia and New Zealand market, I think they are still more for the natural resource or that kind of thing. We still need to learn more.
Great. That's super helpful. Now, for some of the cutting edge markets like clean tech and so forth, do you rely on VC managers to sort of, do you lean on VC fund managers, or do you do direct investments? Or is there a percentage of both?
Oh yeah, so for our private market, that's very clear. So for the VC, unless we know that person, but generally not. So we invest in the VC funds mostly. And in the US, the topic are very obvious. Just AI, machine learning, aerospace, cybersecurity, B2B, semiconductor, and biotech. That's the topics we invest in the US. And in India, we look at some B2B. So I think on the clean tech side, I think the Southeast Asia actually has more opportunity here. So I think but it's just not limited to this. I just say that the current focus for us about clean tech can be everywhere, and also there are a good opportunity in the Europe as well. Yeah, because I think the Europe just leading the role in this kind of the climate change or clean tech in this kind of thing. So that's on the VC side. We mostly invest in funds. So through funds we get access to the direct deals. But we do not invest in a VC directly. However, we can access to their portfolios at the early stage. So we get the better understanding of the companies and of the founder, and we can get some time and see how their growth. Yeah, so probably after another 2 rounds, we will invest in them directly. I mean, we're probably not leading investor, probably be a minor investor or silent partner, but hopefully we can bring some values to the companies. So that's on the tech side. From the traditional business side, those cash cow we can do control investment for sure, but that's more on the buyout side or the PE side.
Okay, great. And so what is your typical duration that you would evaluate a manager or a particular investment before you make an allocation?
Yeah, it depends. So if they are the established name or already have the long track record, that's very quick, about 3 months, something like that. But if they're a fresh manager, I don't know, maybe if you say the first time manager, maybe 6 months or more. But I mean, we need that time to evaluate them, to track them and see how they react. That's for the hedge fund. But for VC, I think it takes longer. It's like 6 months to a year, to evaluate, because as you know, we need to see how they exit. If they are able to do trade sale, I mean, exit is a big issue now. Maybe in the US, there's not that obvious because the US market is still quite of liquid, and there are a lot of opportunities to exit. You can sell to the PE fund, do some trade sale. You can do M&A. There are a lot of the multinational companies there, and also you can do IPO. Although IPO market is not very common at this moment, but I believe they will recover next year. So I guess maybe the US market, there's not that much exit issue, but it's really happening in Asia. So I think when we monitor them, it's more because we want to see how they perform, how they execute, how they do some operational.
Great. Well, this is so helpful. Thank you so much for your insights. This will help fund managers and other capital seekers really understand what it takes to get an allocation. So thank you so much for joining me today and explaining these areas of how you allocate, how you go about the process of finding investments, and again, thank you so much. I really appreciate your insights.